Good afternoon, ladies and gentlemen. Welcome to our special series of Market Gurus. This is in sync with the forthcoming budget as well. And we are deeply pleased to welcome Mr. Maneesh Dangi, co-founder and CEO of Mosaic Asset Management. He's a cyclical investor, believes a lot in probability, and above all, writes very well. He's also been in the markets for more than two and a half decades and has a very strong grasp on global macro, local macro, and of course, stock picking. Namaste, Manish ji. A very warm welcome to you. And these are, as the Chinese say, very exciting times. A lot is happening, which is in favor of India, and a lot more is happening, which is not in favor of stock markets. Given the pluses and the minuses and the fact that you believe so much in probability, where do you think is sentiment on the Lal Street at the moment, with the bears or with the bulls?
I mean, few things can simply be looked at and assessed. So it's, of course, in the grip of bears at the moment. It's also, of course, a kind of questioning the very narrative that people have perpetuated of Indian exceptionalism. And of course, it's also a little bit of a reality check for millions of investors who've entered stock markets in last 3 years that, everything is not changa here. And as you introduced me as a cyclical investors, you know, you sort of are going to, people are going to learn, hard life lessons in this, where they see that stock markets are not about this linear uptrends. They have these cyclical upswings, but, alongside comes these major downswings. It's been a mild so far, but it can get, much worse if things are not addressed quickly.
Fair point. That's a point that you've very well made in your 8-page note that you sent me. Let's, Manishji, analyze it in very simple manner. I'd like you to highlight 3 things that you don't like in the present setup, which might derail a lot of good that the market has done in the last 3 years or so, and maybe 1 or 2 positives that you see emerging as green shoots in the last 3 or 4 months or so.
So the 3 things that, it's sort of, there are many good and bad. I think the 3 top of mind things that I think are going to create trouble for markets are, one, a global macro thing. You could think of this through the lens of tight dollar and higher US treasuries. I kind of, from a realist and business standpoint, you could think of it from the point of view of AI and robotics arms race between US and China. It almost seems like we, Europe, Japan, and many other countries are simply onlookers between this tough fight between US and China, where, you cannot, as of right now, assess who is going to be the winner. And this will have major implications. Trump winning, likely imposing massive tariffs on many products, perhaps even on products, which are coming from, India. So in some sense, a macro setup that we've lived in since 1990 is actually being challenged. That will mean there are going to be some winners and many losers. So that part, markets are all about certainty, and it's likely that markets are living in a lot more uncertain times than, what they're used to for good 30, 35 years. So that's one thing that I don't like. Second, which is very specific to India, is that India is in a cyclical downturn. We've argued about it for the last 5-6 months, even on your channel. I think, the cyclical downturn is actually underway. It still has some legs. Perhaps for 6-8 months, India would slow instead of accelerate again. So that's the part that I don't like. And third, India is, in some sense, Indian investors, retail particularly, is all in equities. Near 8 lakh crore money has come in last 3 years in mutual funds, and a lot of it actually has gone to stocks directly. A lot of people have come to markets with belief that these are linear uptrending markets which will always deliver great returns. That's not the way you and I know markets behave. So that part actually is going to worry a lot of investors. So these are kind of, since you asked me about 3 things, and I'm sort of limiting it to these 3 points. What I like, of course, in India is that we still likely over next 3, 4, 5, 10 years, after the cyclical downturn, will likely deliver 5.5, 6% growth. Again, contextualize it to until 6 months ago, this whole idea and narrative of 8% growth, that's not coming, but even 6% growth is good. So that part is the most solid part. Indian demography is in decent place. Debt is low. Household debt is very high, but the corporate debt is low and can leverage. So a lot of good things, along with, of course, our Indian IT or tech ecosystem can actually plug itself into US and Europe and actually continue to deliver very well. So these are the structural things, that I think we are in good shape. Cyclically, of course, as we deteriorate, we have policy tools to sort of unwind some of it. We're not in 2013 setup, nor in 2009. So I think, these hurts that will markets and the macro will have on us will not be significant.
So this is the broad context that Maneesh offers us, that it's not all that glitters is gold, and we've seen that over the last 5 months or so, a massive correction in major frontline indices and a deep corrective phase in many of the erstwhile market darlings, which continues to this day as well. Maneesh, let's just address the two elephants in the room. One, the RBI took steps last evening to ease monetary conditions in the money market, and has very cleverly given just a signal that you just might have a CRR cut somewhere in the first week of February, when it convenes post budget. And secondly, this insistent threat of sanctions that the US has now threatened on anybody who exports to the US but does not have a manufacturing presence. Look at how pharma has been beaten out of shape over the last 2 days. How do you see these two antagonistic trends in the Indian market playing out?
So one on, good news from RBI standpoint is finally, in hindsight, at least, we are wiser that some of the excessive tightness which were orchestrated in both in terms of liquidity as well as regulatory policy, most specifically to NBFC, was a bit overextended, I would say, and that is being unwound. So the new governor actually is a little bit of a dove, if we were to characterize him as one. Though he would like to claim himself to be an owl instead of a dove or a hawk. But I think, at margin versus SKD, regime until about a few months ago, I think incrementally we are seeing RBI easing up, okay? Which basically is letting currency go. So in a sense, more pragmatic, letting currency weaken. So that kind of obsession with, sort of strong currency does not exist. And also on local conditions, the old tools like OMOs and VRRs are being deployed more actively, as you alluded to, that a very large amount of OMO was launched before that CRR cut happened. I think it's very likely, Chaleji, that it's likely that, a lot of regulatory tightness and the liquidity tightness we went through for a good 1.5 years would be unwound very quickly. And what will follow, of course, is that, once the effect of tariffs is sort of well known, and the unpredictability of Trump and Trumpism is actually known to the market and RBI more specifically, they would also unleash monetary easing, because India is in desperate need of rate cuts right now.
Yes.
Right. So in a sense, that's how I would sort of address your question, that, tariffs and, its impact on pharma, frankly, we don't know yet fully. It's
Yes.
still playing out as we speak. And so
Okay.
in a sense, don't jump to the conclusion that, much what has happened in last few weeks in pharma and many other things is done. We don't know, because it could get much nastier. I mean, I don't know if you heard the Trump speech today,
Yes.
but basically it could get very, very nasty. And please, relate it with the AI robots arms race, which is going on right now. First time, and I think a little bit of a zoom out perspective, it's important for your audience to know that it's not a business as usual. What is happening between US versus China and the arms race with respect to AI, robotics, or high tech is unique. never ever in the past in 100 years, US has been threatened in the
Yes.
very thing that it thinks that it's moat, which is high tech. So what you've seen over the weekend, the deep seek flurry,
Yes.
and it's likely that first time you're seeing that big arms race, get unleashed in various forms. China would do in its own way, but US, like, let's say, it's becoming very, very 19th century like. They impose massive tariffs on all kinds of things. We may end up actually being a sore loser in this process, though we are a small player.
Yeah.
But we may end up, being a kind of what we say in markets, collateral damage, unfortunately.
Fair point. We live with this, with that. How should I say? Not exactly negativity, but something that you are aware of, but you are unable to sort of,
Process.
gauge the impact of it immediately. Fair enough.
Yes, yes. Yes.
Life is all about uh, probability of knowing 51% and let 49% work out yourself. You know it better than me. Now, let's look at the Indian markets. 4.5 months of insistent, very deep, and very painful correction. In mathematical probability, Manish ji, when you look at a lot of data, is the worst behind us? Now that RBI is acting, we have the budget in front of us, Trump is in the seat, a question mark. Nevertheless, we know who's on the seat.
So the various ways to look at it, from purely from an investor positioning, markets are excessively overweight Indian equities, local investors particularly,
Okay.
and more specifically in small and mid caps. And as you know, that the markets, exit lanes are very narrow. So,
Yes.
there are highways available to you to enter, but exit lanes in the market are very narrow. So it kind of creates behavior where investors begin to freak out after a point because they really can't exit easily. So that's one way to look at it. That, as I said, 8 lakh crores of money poured into mutual funds in last 3 years. People don't realize this, Shailesh. Then last 3 years, the CAGR is only 8%.
Yes.
So even though on the narrative side there has been an excessive, euphoria, but there has not been a corresponding gain. So in a sense, this small guy in Udaipur may actually question as to all this narrative of that equity caggering at 15, 20, 30%. In reality, what he has been able to achieve is only, on average, very likely less than 7, 8%. Right? So in some sense, from an investor positioning standpoint, I'm still worried. Uh,
Okay.
Purely from a policy standpoint, I think we are coming to a point of climax. As I said, Indian policies, particularly, let's say, monetary policies, have begun to unwind in any case, right?
Yes.
Regulatory and liquidity, and then very soon we'll see monetary easing coming in India. The fact that bonds are now near 6.5%. Last time when I
Correct.
told you guys about a year ago that bonds will deliver better than equities, it has
Correct.
delivered
Correct.
significantly better. So it's already 6.5. It's 100 basis point rally which has happened, right? It's
I
actually the real
distinctly,
goal.
I distinctly remember asking you, would a good bond fund work? And you mentioned, look, go for AAA paper. This was the last conversation we had on the show, and that's worked out beautifully. Now, coming to the most important task for any fund manager and CEO of an asset management company is allocation of fresh capital. We stand at the doorstep of the budget. Let's hope it's a memorable event and we somehow get relief from this insistent selling that is coming in. One, what are your expectations from Finance Minister Nirmala Sitharaman 3 days from now? And two, how is your own client's asset allocation working at this point?
So from Nirmala, basically it's going to be as market anticipates today. At least the markets, the insiders kind of know that not much can be done. There's going to be fiscal consolidation. Hopefully, a message to RBI and markets that they mean business with respect to consolidation that they've promised, and then pave way for monetary easing. So the bazooka that will come is not going to be from Delhi, but it's actually Mint Street, Bombay, and
Okay.
budget will most probably will pay for it. Alongside, of course, few tweaks in PLIs and tariffs, and tariffs are important nowadays because given the kind of dumping that we're seeing in some of the metals, I think anti-dumping duty is what the various sector specialists betters or portfolio managers are watching for. So that these are the few things, along with lots and lots of announcements here and there. But from a purely macro point of view, I think it's a consolidation plus some tariffs is how most probably we would see this. It's likely that there's going to be a disappointment, because a lot of people today are actually holding on to this belief that something magical will come from budget. Likely it won't come. Likely, as I said, it'll come from Mint Street, which is Bombay RBI, and rate easing and monetary easing and liquidity easing and so on and so forth. So that's how I kind of think of budget, implication on market strategy.
Fair point. And I think, over the last 2 years or so, the middle class has sort of realized that it's unfortunately the only place where insistent and consistent taxation is happening. Let's hope there is an easing on that. But as you very rightly say, there is nothing much that you can expect from the document which will be unveiled 3 days from now. Fair point.
Few tweaks actually, I think these are not for the audience which are wanting to solve markets. But if you're wanting to solve personal finance, there are going to be many goodies perhaps. Let's say taxation, income tax for women, likely to be relaxed. Sort of noises coming in from Delhi that there are going to be small tweaks here and there, all sorts, which are very, very directed. Modi government actually does not believe in macro bazookas outside of crisis. So they are always about normalizing and tweaking things in favor of things that they want. It's more directed in some sense. And I kind of favor that, I mean, basically this idea of actually at this point in time, without a major crisis in the country, to actually splurge is not a right way to go. So I kind of agree to what they do. It's just that, market expectations are misaligned perhaps. Some of it has been course corrected, but, still misaligned. If you ask typical fund managers, there's still hope that something big can come without knowing the constraints that the government faces today.
I think those are more bites aimed at the media rather than something that they would ask their research team to work on. It's, each fund manager has 50% now, actually 52% of his brain working on the marketing side of his schemes, and 48% working on finding out the right stock and where to buy it. That's okay. We are now in the financialization of assets, and it's okay. There are excessives that come into the system. You and I have seen the last 4 bull and bear markets. Every market is like this. It's just that at all points of time, the value of the bull is bigger than the previous one.
I agree.
Now,
it's just that, what is nice about now in today's world, and I'm taking a detour here, what is nice about is that so much information, so much conversation of all kinds are presently available to people that, it's up to them to process it.
yes.
In a sense, they may, and so, the reflex of an average guy, again, philosophically, is to actually find a bearish view distasteful if he's long on the market, and vice versa. I think the right way is to sort of listen all opinions and process this information. Be that GPT-401, reason it instead of simply ask and insist that I want to hear something that I am long on. That's not the right way to sort of approach markets, in my view.
Exactly. We have a common friend who heads a decently sized research team, and he was telling me about 30 to 45 days ago, he's desperate to write a sell report, but his team refuses to let him.
Yes. So in a sense, when I insist that I'm a cyclical investor, I want to solve that part, that there is no incentive structure aligned to what I am saying.
Yes.
That I can be both bullish and bearish.
Correct.
So in a sense, because the only other place to be is to be structurally bullish or bearish, which I don't believe in. Markets are cyclical.
Yes.
There are times when you do very well, and there are times you don't do well. So, at that superficial level, I'm trying to solve, that what I say is what I mean is by claiming that I'm cyclical.
Correct. Now, let's look at asset allocation. At this point of time, Maneesh bhai, there is this fear of tariffs across the world, as you rightly mentioned, because of the man in charge of the US. And you see gold spiking. yesterday when there was pain all around, gold ETFs were doing pretty well, and they've been notching up fairly decent gains. For the remaining of 2025 and maybe a medium term horizon on gold, what would that be in terms of expectations of return and allocation within portfolio?
Yeah, so I kind of I don't have a I'm a good analyst, let's say, with respect to financial markets. I understand gold that there should be some small allocation to it. I'm aware that as a matter of fact, over long periods of time, because gold does not yield anything, it's a zero coupon bond for million years. Kind of think of it like this. So in some sense, unless it's a gold investing is a investing in sort of a news heavy market, so to say. Because there's so much uncertainty. What do? You rush to something that has held steady for past millennia, right? So that's how I look at gold. So maybe 5-10% allocation, because Akbar and Ashok also believed in it. So therefore, might as well believe in something, to the extent of 5%, even though it earns zero. Other way to look at it is actually it's a short dollar trade.
Yes.
But unfortunately, it's a short dollar. Right now, the way it's working is that it's a short dollar and short INR trade.
It
Both.
was always a short INR trade.
It was always INR, a short INR trade. For an
Right.
Indians, actually, that, okay, how do I protect myself from an inflation bogey that, government will unleash on me,
Yes.
is actually own gold. Now, it's also short INR, like Bitcoin, gold are mostly short INR trade right now. So, in a
Absolutely.
sense, it's a global money wanting to move to some place, but not INR and CNY. Therefore, it's going to the alternate currency, which is gold.
And when you mentioned Akbar and Ashok, you failed to mention the Indian housewife. She's been right on it for the last
Yeah, yeah.
10,000 years. And
Yeah, Meera and Lakshmi. I
yes,
mean,
and they laugh their way to the jewelry shop and beat all fund managers hollow by buying at the
absolutely.
right time.
Absolutely, last 20 years of great bull market and equity, and this lady and the man there in the small village, perhaps you really don't have a face to say that, look, his or her holdings actually did much better without tax, by the way, no capital
Correct.
gain tax.
And the government has now decided not to float the SGB, the sovereign gold bond. Look at how the gold bond is trading at a premium in the market, the listed gold bonds.
Yes,
So
yes, yes.
too much of education, too much of studies in the markets are very, very dangerous. When you compare yourself to a person who just looks at the gold price and says, चलो अभी एक महीने रुक जाते हैं या आज शाम को चलते हैं.
or basically our cultural training that
Yes.
if something that Ashoka and Akbar believed in must be true, and
Yes.
therefore I must buy it.
Yes.
I mean, you can't dismiss the cultural reflex of a person. So to that extent,
Absolutely.
yes, I give in to it. I'm not a great fan of gold, but you have to admit that, look, the history has taught you again and again that gold does well in
Absolutely.
uncertainty, and we are living in uncertain times right now. So it's
Absolutely.
doing really well.
When I meet you in person, I'll tell you that I have started buying physical gold because a lot of women have now stopped buying jewelry, and I decided it's now men's turn to sort of doll up. So when we meet, I'm going to tell you some very interesting stories. Okay, now we are past gold, we are past equity, and we are past macro. The other thing I noticed in your 8-page note was how closely you track quick indicators, which is auto sales, both passenger and two-wheeler, tax numbers, electricity usage, so on and so forth. I just I want to look 3-4 months ahead and check with you, is the GST number, the 12% that they are targeting each year on, month on month, year on year, calculated year,
Yes.
is that at risk?
Almost certainly, because GST is the best proxy of retail sales in India.
Yes.
And, you really cannot have, buoyant GST when household uh, seems to be having an income stress, and which is expressing itself in results of all the microfinance firms. You would have seen Spandana's results and so credit
Yes.
access results. So, I mean, clearly household in India is in stress right now. And so therefore you cannot assume that the man is actually finding it difficult to repay loans and actually still going and buying mobile phones. So these
Yes.
two incongruent, so to say. So I kind of think that next 6 12 months, government finances have small threat. The good news here is that Nirmala ji has actually cleaned up the balance sheet so well in last 5 years that there are cushions which exist in the government balance sheets that will absorb a lot of these small shocks that we will likely see. The bad news is that it's a matter of fact that we have clear indications that household is in stress, and without external assistance, it clearly will not revive meaningfully. It's not falling off the cliff, but it's
Yes.
certainly you cannot dismiss that there is stress, which is apparent in Indus's result, in RBL's results, Spandana's results. It's all over the place. So it's sort of very well known now that so 6 months ago, Shailesh, when we were talking, I was speculating. It's no more
Yes.
speculation. It is
Yes.
it's a news in our town, both Delhi and Bombay, that there is stress.
There is stress. And which parts of the market would you avoid completely, given that this stress is now very well documented and perhaps increasing?
So look, I think Indian cyclical stress, will come and go. In 3 6 months' time, things will revive. So to that extent, I'm not sort of not a consumption bear in markets. Anyway, we haven't had a great consumption boom, by the way. And
True.
it's not that the last 6 12 months things have slowed. As a matter of fact, last 10 years, two-wheelers have grown, volumes have grown by 2 3% CAGR. That's it.
Yes.
The car sales have been, only 4 5%, 5% or thereabouts. That's it. So we haven't had a consumption boom. So see, you can't have a bust when you haven't had a boom.
Yes.
You will have a bust when you have a boom. And where have you had the boom? Which is the household leverage. You
Yes.
know, caggering at 15 20%. That is where you're seeing bust right now. So I'm
So,
worried of that bust as a first order. I think I'm more worried right now, frankly, is what is happening in China in terms of its heft in manufacturing is rising by the day.
yes.
So, you must watch what is happening in Japan, Thailand, with respect to Toyotas and Hondas of the world. And what's happening to Volkswagen in, let's say, in Germany.
Yes.
Dwindling sales, OEMs are actually in mess right now. And you almost certainly can, when you go to US, China, you can see that your cars today, what we are manufacturing, are kind of 5 7 years behind versus where China is producing right now. So I'm worried that anything that China does well, Indian manufacturing will face tremendous pressure, Shailesh, in next 3 5 years right now, and that also is a hyped up market.
Yes.
In some sense, you've alluded to it that some bit of it is given up, but still also pretty hyped up. India manufacturing theme is very hyped up in markets. In reality, it's not done well. So to that extent, I'm sort of worried of that part. On the
Manish
other
ji,
side, I have to talk positive. Once, just a small point.
yes.
Indian IT actually is we've discussed about it for 6 months. It's a great defense for you. It is very well integrated with global IT, global tech. Will likely have massive benefits coming in because of AI, not because they will hire more people, and to that extent Indian engineer is worse off, but Indian companies like TCS and Infosys of the world are actually better off because a lot of AI agents can do the stuff, including coding, that otherwise you were to hire engineers. So to that extent, I kind of Indian tech ecosystem and IT particularly, I'm quite bullish on, alongside of course power we've discussed in the past. I think because if AI and the cloud have to boom, you need power. So I think these are the 2 or 3 businesses that I think I like in India.
Okay, fair point. And power producers or power ancillaries?
So everything related to power,
Okay.
but not non-solar. I mean, again, just make sure that you don't compete with China when you own something, because China in manufacturing is such a hegemon now that very given the scale that they have and the amount of money that they put into research,
Yeah.
it's very difficult to compete with them now for where we are in our country's sort of evolution. So to that extent, we must play from a market point of view. We must play our strengths, and our strength is tech, IT, that is, to a certain
Okay.
extent, pharma that we've discussed in the past, past the problem that we are going through right now,
Yeah.
and power because it's very local, alongside of non-tradable goods in India, like, like cement and stuff, you can't import from outside. So after the cyclical downturn, they will actually come back in vogue. So non Chinese businesses, where you don't have to compete with China is the place that you have to be.
Okay. And a personal anecdote here in our very large basement in Noida. Manish, compared to a Mumbai wala, we are very fortunate to have a lot of space in Delhi, especially in Noida. I want to rub this in particular.
I am okay, as long as the trade-off is between a bigger house and AQI. I'm okay. I give it to you. Live with 600 AQI.
Okay, so it's 1:1. But coming to cars, so there is a lone BYD parked in our office basement, and when you go past that car and when you reach your own vehicle, there is that it's a deep pain.
It's a pain. I looked at it, I was traveling once, I was like, I looked at it in awe.
Yes.
In some of the countries like Malaysia, Thailand, you see how Japanese are being wiped out.
Yes.
By the BYDs of the world.
Correct.
No, that like $5, $7, $8,000 cheaper cars with better specs.
Yeah.
In unbelievable. So the China to car is exactly what China became in 2010s to solar panels, or
Yes.
in 2000s for the mobility, mobiles. It is becoming a hegemon in cars right now. And by the way, cars is a very, very large business in India, and even from a
Yes.
GST standpoint, and it's a very large manufacturing, which we genuinely could have said that it's the make in India that we've been proud of for last 30, 40 years.
Correct. Manishi, before we sort of part ways, I just wanted to understand your view from the point of US 10-year yield and Indian 10-year yield. Now the difference is about 200 basis points. How do you see this in the coming 1 year, given that we'll have a rate cut cycle in the offing, and perhaps the US 10-year yield will also ease?
Yeah, so you actually, this is the complexity of life, that you look at India slow down, you look at RBI reflex, you want to be bullish on India, and then you look adjacent outside and you see China at 1.5% on 10-year
Yes.
bond. You want to be more bullish on India, and you think of budget and you want to be even more bullish because they're actually even further consolidating. And then you look far and see US at 4.5%, and you say, oh God, this is so expensive. I mean, our bonds are so expensive. So you nailed it, that, even though internally it seems an attractive trade relative to equities, but if I was a fund manager who had access to both US treasuries and India bonds, it's very difficult to be long India bonds if I can't be long in US treasuries. So I think the better trade in the town, of course, is US treasuries. But this I don't discuss because it's most part of your audience don't have access to US treasuries. Yes. But I agree with you that the condition precedent for bonds to rally incrementally is going to be US treasuries rallying and US dollar actually stopping to strengthen. Perhaps a time will come, maybe in 1 or 2 or 3 months, once the Trump flux is over to a certain extent, market has baked that in. Maybe there's going to be a time to sort of go extra long India bonds yet again.
Mr. Trump is a better timer of the market than all of us put together, and he knows when to needle you and when to remove that needle and apply balm. So it's going to be an exciting 2.5 years, 4 years ahead, Manishi, and we'll obviously look at a lot of sense and direction coming from you as to how to manage portfolios and how to invest fresh money. Thank you for joining us. I hope you enjoyed the conversation as much as we all did.
Bye-bye.
Bye-bye. Thank you so much. That was Mr. Maneesh Dangi, the co-founder and CEO of Mosaic Asset Management. In this time and age where you have a lot of pain in the market, he suggests two themes. One is Indian tech ecosystem that will benefit with this thrust towards AI and robotics. He's hopeful that Indian companies will hire less and less, which basically means that their margins will improve. Power is a sector which he likes because all consumption is internal. So whether it's power ancillaries or power producers that find favor with him, and of course any space within the Indian ecosystem that doesn't compete with China may offer a medium-term opportunity to make decent long-term returns. Thank you so much for watching. I hope you enjoyed the conversation as much as we did at Business Today. Remain glued to the television. We have more coming on the other side of the break.
Watching Royal Ranthambore presents BT Golf. I'm